everyone, and Happy New Year to you. This is our first report of 2016, and we're going to try to do this on a monthly basis and as needed based on events as they occur throughout the year. And we thought after last week's sort of cold beginning of the new year, both weather-wise here in New England, but also in terms of the stock market, which had about a 6 percentage point drop in the major indices last week, in the first trading week of the year, that we give our perspectives on that, as well as looking forward to 2016 and sort of what we see based on current input as to how best to approach the year. And so going back to last week, it kind of reminded me of last summer, where we had some geopolitical events as well as some concerns about China, as well as the energy sector sort of coming to the fore. And we had that again last week, where we had a new round of weakness in terms of the energy, in oil in particular. We had China and other Asian markets, again, showing some concerns about their markets in general and how they function, but also their growth rates looking forward. And then we had some additional geopolitical concerns surrounding Saudi Arabia and Iran having some tensions, as well as North Korea, and some concerns about North Korea and potential advancements in their nuclear program. So when you have all of these things, as well as a new year, it caused some angst. And our feeling is you take a step back, kind of look at those world events, which do impact us, but also take a look at where we see the U.S. economy in particular moving forward. And it sort of enlightens our approach to investments in 2016. And I know Mike has done some thinking about that. I know I have. And why don't I turn it over to Mike, and we can kind of make some comments about that.
Well, it certainly was one of the worst starts to any year in quite a long time last week. However, with all that noise going on geopolitically and from a macro perspective, I think there are three key things to keep in perspective. Number one is commodities. Gary talked a little bit about oil, but if you look into commodities in general, whether it's steel, whether it's copper, whether it's oil, anything that we use in our economy, it is ironic now that prices are very, very low. And typically over the long run, that should be excellent for the U.S. economy. Over our lifetimes, especially for Gary and I now that we're in our 50s, we remember a time where we had to wait in line to get gas in the 70s and 80s because gas prices were very high and oil was in low supply. We have the opposite problem now. In fact, Congress is voting or has voted to allow the U.S. to actually export oil. Gas prices haven't been this low in a generation. As a result, that leads from commodities to the consumer. This decrease in gas prices, oil prices for heating, and other commodities will lead to a boom for the consumer. The U.S. consumes almost 400 million gallons of gas per day. Saving $1 or $1.50 a gallon leads to enormous amounts of money into the hundreds of billions of dollars that will remain in the U.S. economy. As a result, we think the consumer will be relatively strong for 2016. With that, that should help corporate profits for domestic companies. And if corporate profits are good, it should lead to a steady increase in the stock market. So underlying all of this noise and the macro problems in the world, which we always have, is just a question of what they are, we do think that we do have a steady economy, at least for the first half of 2016. Of course, there are elections in November of 2016, and that will lead to all sorts of other issues. But in the meantime, we think it's important to sort of hold steady and focus on certain parts of the stock market, to include healthcare, and domestic U.S. large capitalization stocks.
You know, this may be a year of some periods of high volatility. As Mike mentioned, the elections, we're going to be treated to a lot of advertising, some not so positive. And these geopolitical events do happen from time to time, and they tend to have sort of a short-term impact that over time, and as the markets have a chance to digest it, and as corporate earnings and the economy in general, that information comes to the fore, those geopolitical events tend to dissipate over time. What's happening in the rest of the world is certainly important, but as Mike mentioned, the U.S. economy is still in an expansion phase. It may not be a super high growth, but it's still sort of a steady growing situation. We're very heavily consumer-based in the United States, so we're in some degree not as impacted from international events as other countries may be. And so we do think this is a continued year that's constructive for equities, and because of the volatility and because of our stage in the cycle, it's always important to look at these companies very closely, or the sectors you invest in, but selectivity is particularly important this year, and making sure that we're in companies that are have great leadership, market leaders, is very important, and diversification as well. So the housing market is still growing, other sectors.
Yeah, it's very important right now just to understand volatility can be helpful though too, because this is a great opportunity to pick up some of those stocks that have been battered, not necessarily for any good reason other than everyone is selling everything. So someone is selling, someone is buying, as always. With these volatile dips, it can be a real opportunity to acquire some stocks so that we can actually buy low and sell high. That's sort of the idea here. So volatility can be our friend in certain ways if we embrace it, if all the fundamentals are still in tune with the equities that we want to purchase. And when it comes to bonds, obviously interest rates have ticked up a little bit, and the Federal Reserve looks as if they want to increase interest rates a little bit. So we tend to recommend buying individual bonds where you can, as opposed to bond funds and other things, so you can control your interest rate issues.
So we're going to keep watching these events as they happen throughout the year. We're going to watch those corporate earnings as they come in. We hope you'll watch our monthly reports as we give these updates. And again, from time to time, as events warrant, we'll come out with special reports. Thank you for watching.